Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. My name is Derek Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gower, Director of IBM Digital Assets and CTO of Portal. Good morning, good afternoon, good evening, wherever you are in the world. Welcome along to Beyond Bitcoin, of course, a program on all things really aren't focused on Bitcoin. Along with me today is my friend and colleague, Nitin Gower. Hello, Nitin, how you going?
Hey, Derek, good, glad to be here. And this week I'm calling in from India. A lot of exciting things happening here, which we'll discuss a bit of on this session. And glad to be here.
Terrific. Now, the topic today, I think, has been partly dreamed up by just the extraordinary correlation of volatility that we've seen in the markets lately. That is the correlation between digital asset markets and the equities markets, and just the enormous position that now we are seeing stablecoins take in this. And I think your thesis on it is fascinating. So let's work through that a little bit. And I'll maybe do a bit of a preamble to this so people get in context just how large and how important the stablecoin role really is in this space. So stablecoins are one of the most important aspects of all of cryptocurrency. All major trading pairs in central exchanges and decentralized exchanges are denominated in stablecoins. The volume of stablecoins often exceeds both Bitcoin volumes and Ethereum volumes. Stablecoins are by far the most borrowed assets on decentralized money markets such as ARB, and they're 27 times more borrowed than that of ETH. Stablecoins are, in fact, really, when you think about it, the foundation of decentralized finance. But here's the conundrum. Of the stablecoins that exist, 83% of them are stable or pegged to fiat currencies. And the issue then starts becoming, well, if such a large volume in this marketplace are stablecoins, and such a large volume of the stablecoins are pegged to fiat currencies, are we just creating another environment here to reflect a lot of value in traditional assets and traditional currencies, fiat currencies, in a market that is started in a rebellious manner, trying to depart from that? What do you think, Nick?
No, I think that's a great point, Derek. And I think as I was debating and thinking about this, and I've been thinking about this for over 8 to 9 months as to why is the fact that when we start this journey with digital assets and blockchain and Bitcoin, the intention was to reinvent and build another financial infrastructure. So we're not just sort of creating a market infrastructure with, creating new rails, creating new assets classes, creating new economic systems, and trying to remove the inefficiencies of existing systems, namely the volatility, instability due to some of the government, actions, the global macro, the interest rates, the inflation, and much of that is, rather created by humans, which is by us in terms of faulty policies or hasty sort of quick fixes in the economic system. And as I'm looking into this, we begin to see now an impact of the global macro on crypto markets. We've seen that with Bitcoin recently. We've seen that with the fact that, while Bitcoin was notorious for being volatile and being sort of a currency that was not something to be trusted, we begin to see, Bitcoin sort of be quite tamed, compared to where it was before. And I'm looking at this and, figuring out the linkage of volatility and stability of crypto markets is something we got to discuss. The impact of all the numbers that you mentioned, Derek, which is, again, stable coins being the most important aspect of crypto. It is the foundational, asset class of DeFi ecosystem. Why is that? Why is, there's so much money being poured into it? Well, primarily the introduction. I think the last time we had this session on stable coins, we did talk about the emergence of stable coin. Well, we have stable coins because people needed some fungible asset that compared to what we are used to, which is US dollar and euros and fiat currencies. And the emergence of digitized or tokenized fiat became a step-through currency or step-through asset, which allowed for many of the crypto industry traders and ability for the exchanges to be able to provide a mechanism to have instant settlement only because we couldn't rely upon a banking settlement, which takes 2 or 3 or 7 days in some cases, for a truly digital instant real-time settlement ecosystem. And in many cases, the layer one, which is a settlement layer, which we will talk a little bit more about, I think it's fascinating from that perspective. We begin to now see that collectively over $300 billion worth of stablecoin, largely in USD, which is in the ecosystem. There is a tight linkages between the volatility of global markets, which is what we see in the global capital markets, and the stability of crypto market, and the impact of volatility, which I mean, which I think comes from two parallel financial systems that are at play at the moment. So if you look at some of the names, the Aave and the decentralized exchanges and Ethereum ecosystems and Bitcoin ecosystems, these to me represent the parallel financial ecosystem which has its own economic incentive structure, which has yield and which has returns. And if you were to take an example, for instance, a high yield in crypto markets, it's to attract liquidity, right? The fact that you have higher yield as opposed to an interest-bearing account in a bank is because we would like to attract more liquidity into the system, because we need more and more liquidity to be able to trade these assets and attract more participants, including institutional participants more lately. And while the risk on, risk off equation at play will attract capital and issuance of stablecoin, it also inherits, in my opinion, the mechanics of global macro, which implies that any shift in traditional finance, capital markets, interest rates, money supply, inflation, etc., which plays an important role in the calculus that goes into asset valuation. So as you know, inflation eats into your asset valuation, inflation eats into your overall holdings. We begin to see some of that elements into the impact of stablecoin coming into the ecosystem have a massive impact on crypto markets, which in principle is meant to be independent and disruptive. I'll pause here for a minute, Derek, because I think there's a lot to unpack here as we look into this piece, but I find this equation worth the study. We should spend some time in studying that equation, but also ironic that as much as we're trying to break the shackles and get out of this sort of system, we keep getting pulled back in, whether it's a stablecoin or in future central bank digital currencies, which is one of the reasons why I'm here in India this week. So I'll pause here and love to get your thoughts, Derek.
Well, you're absolutely right, and the ironic part, of course, is because this ecosystem is trying to rebel against the monetary policies of the globe and the manipulation and strategization of monetary policies from one country to the other. But we have a problem, and that is that we have a legacy rationale relating to how you have units of value. And that legacy rationale, maybe a few hundred years ago or 1,000 years ago, might have been in Spanish doubloons. And all this would have been in SBs, SDBs through here, because that's what we understand. We understand US dollars. What is Bitcoin worth? I don't know. What's it worth against Ethereum? What's it worth against another product? Because there are all sorts of, there are all sorts of valuations of Bitcoin. The one we look at is the valuation against US dollars. And it's this cultural challenge that we've got that moves from one space to the other, and we haven't managed to shake it off. We keep looking at the value of this space and comparing it to a US dollar currency, which of course, I'm sure the US government is very comforted with, as I've regularly said, the great check writers of the world. But the reality is we've got to step past that. And your statement in regards to the current volatility, because we've often said in this space that cryptocurrencies or digital assets are uncorrelated with equities and real estate and bonds. Well, that is becoming less of the case.
Sure.
And now we're seeing a correlation, which I think I saw reasonably quoted recently, which is a little bit north of 80%. So it might decouple and become uncorrelated in due course. However, the correlation at the moment in this time of volatility is very high. Do you think that's because we are so thoroughly pegged to fiat, or do you think it's simply because this marketplace is liquid and in times of trouble, risk money rushes away from areas that it can have liquid access?
No, I think that's a profound question, Derek. And I would say there's a little bit of both. One, the crypto markets in general were very fickle and they were very volatile, as we know, only because there were some things at play, both in terms of demand supply. There was Bitcoin halving. There's 90% of Bitcoin that actually has been mined, and and that's an example. And every network, for example, Solana and Cardano and Ethereum, they had their own incentive economic system. They had their own supply and demand ratios, and all that led to this inequitable sort of relationship between the various crypto ecosystems that are at play there. So from that perspective, I think that some of the elements that were sort of driving this agenda, for example, in our stablecoin conversation, we looked into the element of the fact that that stablecoins sort of were introduced because we need to stabilize this sort of a ratio which was inequitable, right? Yeah. So the whole thing is we discussed the entire emergence of stablecoin coming into this ecosystem, and it was there to provide liquidity. And I think that because of inequitable ratios that is transpiring in the crypto ecosystem, and now we have seen interesting sort of movement in our global macro, both in terms of inflation, both in terms of asset pricing, both in terms of massive amount of money supply in the ecosystem. That instability, I think, that volatility that's been driven from a global macro, combined with what we've seen in crypto ecosystem, I think is the reason why we are seeing what we are seeing, to answer your question. But I would take this to a step further, Derek, which I think, again, in effort to study this, in the conversation we had with stablecoin, both in terms of the types of stablecoin. So if you recall the conversation, we had three types of stablecoin. One that had one-to-one pegged to a US dollar or to a fiat currency, which is a centralized entity keeping stablecoin and issuing a token as a collateralized token. And then you had something called a collateralized debt position. These are like things like make or die, which is over collateralization of an asset and trying to maintain price stability by over collateralization, which oftentimes can be considered inefficient because suddenly now you're locking in these assets because of the volatility that we discussed earlier. And the third one was algorithmic stablecoin, which is basically a stablecoin having its own value by the virtue of algorithms that define its value per se. Now, we have seen a massive success with the fiat-backed stablecoin, the USDC, the USDT of the world. These are the banks now getting into issuing stablecoin only because of the demand of liquidity and using them as a payment instrument in the crypto ecosystem, which was highly illiquid back in the day. And then you have the collateralized debt positions. But I think that the challenges we see now, which is what you asserted, is the fact that because of the massive influx of stablecoin, you begin to find tight correlation between the crypto markets to the traditional financial markets. We begin to see the emergence of algo stablecoin, which represents, in my opinion, the best opportunity for DeFi to solve the stablecoin sort of challenges in terms of disassociating and providing the disruptive infrastructure, which again, stablecoin has brought us back into the tight linkages that we discussed earlier. So that algo stablecoin, I think we should spend some time on that at some point, because while it was deemed illegal and it's complicated, it does represent a massive opportunity for us to be its own sort of ecosystem, its own liquid sort of asset, which is much needed in this space. I'll pause here, Derek, to get your point of view.
So they only represent about 7% of the total stablecoins currently. And that's about $13 billion. We quoted before 83% of it relates to stability against fiats. But could we possibly jump this entire culture by aggregating a number of assets, commodities, currencies throughout the world to make one aggregated currency? So by example, if you were to take iron ore, if you were to take wheat, and if you were to take US dollar, UK pound, euro, and each one of them, you bundle them all together in a certain ratio, and then you can do this very easily, and then you have an algorithm that's based against that. And all of a sudden, against the world's major commodities and the world's major currencies, you could have a token which wasn't a US dollar token. And surely that would be the most stable coin you could have. Or are we just facing the same problem because no one really knows what the value of that coin is and they want to see it in US dollars at the end of the day?
Yeah, no, I think to me, Derek, what you just mentioned is a whole can of worms. So first, the entire global commodities market has been measured in US dollar. As you know, as a global reserve, the entire trading pair that happens between various commodities is backed with the US dollar, and US dollar became sort of a lingua franca of currencies to dictate the valuation of these assets around the world. Second thing is by aggregating these assets, which is what Libra had done back in the day. If you remember, Libra in its early days tried to peg its valuation by pegging to the basket currencies, which is what IMF uses, which is USD, GBP, yen, and Euro as the four basket currencies. And that was deemed as the fact that, look, how do you maintain price stability? And that was questioned by many governments around the world to look into saying as to, one, I think your thesis of suggesting that if you have a diverse set of commodities and diverse set of asset classes, a downfall in one and rise in the other will stabilize the price value of the asset. But nonetheless, these assets are still priced. Again, talking about the fact that, the role of what USD does, which is the entire valuation of these asset classes, if we are still tying to the commodities and other asset classes that are still have some valuation to USD, inadvertently or indirectly, we are tying some value of this particular stable coin to the US dollar. So whether we are doing it directly by tying it to a stable coin, which is a fiat peg, or we're going through this indirect mechanism of tying them to commodities and a basket of commodities. And so all basket of commodities do is hedging your risk. Essentially, all that is doing is diversification and maintaining price stability, but you're still tied to the global macro. You're still tied to the existing financial system. What I'm going after is figuring out a model that completely disassociates itself and creating a new financial market infrastructure divorced from the existing world. I'm not saying existing world is bad, because we still live in it and it's working fine, and there are some challenges, and I don't think any system is perfect. But I think that having two parallel financial infrastructures gives us a choice to pick the best of both worlds. And you cannot do that till you have a much more functioning, stable financial ecosystem and financial market structure that will provide for the true valuation of how we move things and how we value assets in those ecosystems.
So is that the CCI 30? Is that when we're talking about the cryptocurrency index top like 30? Is that the new sort of internal token? Because obviously it could be, because that would reflect, that CCI 30 by memory reflects 85% of the capitalization of the 15,000 tokens that sit out there. And so it could be that. But what's wrong with having the CCI 30 and a basket of commodities and multiple currencies around the world in a single token? Or are we just always going to go, well, that's interesting, so we'll pair that, but what does that actually mean in US dollars?
Yeah, no, so I think two things. One thing is, if you're simply pegging to some arbitrary valuation mechanism, we're still tied. So remember this, right? The equation of what we have seen with stock to flow model in Bitcoin, for example, right? There's a certain demand, and and the crypto industry specifically is always criticized for creating this artificial sort of scarcity, which is a significant part of our incentive economic system, as you know, from a Bitcoin and Ether and many of the layer one protocols, which truly represent the liquid assets in the crypto ecosystem. So suddenly now, if we bring in other asset classes, again, for the sake of price stability, then the dependencies, so it's no longer uncorrelated. So because suddenly now we have correlation to commodities market, we have correlations to currencies market, we have correlation to other asset classes that we choose to put in this basket. And one thing that I think I've been looking at this is, again, we've had this chat on this forum early on to say that when we compare layer ones to nation state, remember that chat when we compared Ethereum, Bitcoin, that these ecosystems attracting the best capital, the best talent, so they actually have a nation state status. Layer one protocols then have essentially become the truly liquid asset, which means that anybody in the world who has Ether, Bitcoin, or Solana, for example, they are able to then play in this ecosystem and exchange them in decentralized exchanges and go after asset trading pairs that are tied to layer one protocols like BDC and ETH. So the question is, at what point do the layer one protocols, the prominent layer one protocols who are supporting that ecosystem, who are dominant, who are truly global in nature, provide legitimacy as a currency of sort? Because remember, at the end of the day, we use the term cryptocurrencies a lot, but I don't know if we're truly using Bitcoin and Ether anymore as a currency, because any currency is supposed to have three characteristics. That, again, a medium of exchange, of account, and store of value. But many of these layer one protocols have sort of distilled down to a entity that actually has sort of ability to store value. They don't really use them as medium of exchange. And that's where I look into this whole element to say, if, for example, algo stablecoins, which, as we discussed, presents an opportunity for DeFi to adopt and sort of break that sort of dependency on the ecosystem. But therein lies the trouble, because many of the algorithmic stablecoins are complicated. At times, they have a regulatory cloud on their legitimacy, in the sense that there was a basis coin back in the day backed by some of the biggest venture firms, but because of algorithmic, just like the USD money supply is, it's dependent on certain algorithms, and that was deemed illegal because that's exactly what central bank does. And then, due to complexity of some of the stablecoins like FAI and FRAX, it provides an avenue for many of the folks who understand this better than the rest of us to take advantage of that complexity. I think some of these are plagued challenges, but I still think we do need something that actually has a price stable asset, even if that means that it's layer one protocol. Let's say 10 years from now, if Bitcoin actually finds that stable price, or Ether finds a stable price, using them as a currency is still a viable option without actually having to resort to any of the other artificial mechanisms to provide price stability. I'll stop here, Derek, to see if that even made sense.
So that conundrum brings us all the way back to where we started at the beginning. And that is, we bought these stable coins in because they're stable. And currently, these major distributed ledger technologies, their price is not stable. The DLTs themselves may be stable, but their price is not. And even if you bundle them together and you put in Avalanche and Solana and probably say the top 10 stable coins that you put in there, they still have a very high correlation to each other. I've noticed the correlation of sort of the tier 2 stable coins, the tier 2 distributed ledger technologies, tends to often be about 3, 4, 5, 7 days behind a turn down of the top 2. So you'll often see them sort of hold out for a period of time. But at the end of the day, they're correlated, which means a combination of the top 10 distributed ledger technologies would still be fairly volatile and would not be a stable token in the meantime. How do you create then a stable token? Because I think it's a brilliant idea, because it's essentially the foundation of each one of these sovereign nations, as we've referred to them as, and we're bundling them together like you would bundle together a basket of currencies. We're bundling together a basket of sovereign nations by virtue of each one of them being a distributed ledger technology or the blockchain foundation of each one of those nations. But they're still volatile. What do we do in the short term, Eden?
Yeah, no, I think that, I don't think I have the answer to that specific question, because it's hard, Derek, in the sense that, so remember and maybe we should at some level bring this risk model framework, which is my favorite term as I'm designing the token economics of some of the clients that I'm working with, is figuring out what are the risks that a token valuation, for example, first figuring out as to how a token gets its value. Second thing is figuring out as to what are the risks that can sort of devalue that particular token? And some of them are, of course, legal and regulatory risks that, with the stroke of pen, many tokens can be deemed illegal in the mainstream financial media. And that could be a challenging part. Second thing is protocol risk, because, for example, Ethereum has its own protocol risk as it's transitioning from where it is today and going to ETH2. There's a technology risk that tech may not work. And if it had all kinds of glitches, then Ether may lose its value overnight, or let's say the economic shift that you're going from proof of work to proof of stake has an economic impact on the token valuation. So you have all these risk factors, which as each protocol transitions, I think it's too much of a change for something that we aspire for it to be stable. So remember this, right? The blockchain ecosystem is very dynamic. It's very fast moving, and we aspire to create a token that actually has a long-term price stability to it, which allows us to use that as a fungible asset, or use us as a unit of account that allows me to, take the stabilized asset and sort of create an ability for it to be able to use it as a step-through currency. So I think from that point of view, this is an interesting topic, and I don't have all the answer. I just think that relying on layer one protocols at times may be a much more better option on the long run. Is, let's say, for example, and I think we've discussed this as well in the ecosystem as well as in this show, that there will never be one blockchain that rules them all. There'll be a dozen. And if those dozen becomes sort of the dominant infrastructure layer, which is like Ethereum, Ethereum and Bitcoin, and let's say Solana, that's an emerging one, and Cardano, that's another emerging sort of layer one protocol. Can that not be as used as a currency? And exactly what we have done with the nation state conversation is use them as a currency pair and be able to use them as we move across the ecosystem that each of these layer one support. And that's the world I envision, though, even though I think Bitcoin, with all the things that are happening with Taproot and smart contract ecosystem, Bitcoin may become the US dollar of that ecosystem, where Bitcoin becomes the step through currency between those different layers. That if you want to translate a Solana token for Ether, then you sort of use Bitcoin as a step through currency for it to move through it. I think that's the world I envision it, which again allows us to keep the two systems parallel. And maybe there's a bridge, and that bridging has both an upside and downside. Upside is the fact that we can sort of have a much bigger asset valuation mechanism between the crypto ecosystem and the traditional finance ecosystem. But the moment you create those bridges, which is what we have done with Stablecoin, you are not exactly divorcing yourself. The correlation is still there because of the fact that liquidity coming in or moving out has an impact on asset valuation in both the markets, which I think is something which will go on for some time until we completely do a switch over to a crypto-driven or token economic system, which is what we envision to be a 10, 15-year journey from now, I think. Does that make sense, Jack?
So we can call this the Nittengauer index, in fact, of the top 10 or 20 blockchains or distributed ledger technologies, the underpins these sovereign states and reflect that as a token, the NGDT, and it's a Nittengauer token. But the point is that it makes good sense. It's just possibly not ready yet because the stability is not there. And people will, generation steadily head towards these potentially larger, dedicated industry stable solutions that you're thinking. I think the idea makes just a lot of sense. It's an opportunity to be able to unshackle from traditional marketplaces and go, no, this marketplace is standalone. These are, in fact, the currencies of each one of these giant sovereign states. And accordingly, this basket of currency is how we have, how we tend to do our trading pairs and how we look for stability. It makes a great deal of sense. But in the meantime, we've still got this interesting situation that is this connection to stablecoins and also the rapid creation of central bank digital currencies, as we've talked about a few times before. And sometimes I've heard people say, I remember, of course, the famous quote from a member of the Reserve Bank in Australia, that once Australia creates its central bank digital currency, there will be no need for any other digital currencies. And I thought that was a fabulous statement for a man that obviously puts us at the epicenter of the globe. However, of course, we know that's not going to be the case. But a question I would ask is there going to be a conflict between a US dollar central bank digital currency or a euro central bank digital currency and stable coins that are US dollar stable coins or rather euro stable coins? I mean, if there is a CBDC that comes in, will there be need for these stable coins?
No, I think so. I've done this for like 8 years now, figuring out, and I think stablecoin to me will become the proxy for CBDC because we've studied this for quite some time. So if you look at the recent things that have happened in the last 2 weeks, institutions, BlackRock, one of the largest asset management companies, and looking into this, has 10 trillion asset under management, is prepared to offer a cryptocurrency trading service for its investor clients. And at that point, you see a bunch of other Wall Street banks and Goldman Sachs and Morgan Stanley and Citi choosing their own strategies where they want to go in this space. And recently, for example, BlackRock and with their Aladdin platform, which is the asset managers integrated investment management platform, has talked about providing those trading services. The question is this, that there are many implications beyond technology. So all the conversation that we've had in the ecosystem with CBDC has been very centric to tech. Can we use DLT? Can we not use DLT? Do we need to use account-based model? Or do we need to have tokenized-based models? What's missing is some of the element of the fact that CBDC or central bank digital currency, it's not just about digitizing fiat. It's not just about taking your notes and virtual currencies that are trapped in ledgers and let's create tokenized form. While that may have some merits, I think the implication there is what does it do for existing market? Does it change the existing market infrastructure? Does it change the liquidity requirements? Does it change some of the elements of what banks do, which are credit engines?
Yes.
Like, does it take away the
Huge.
fractional reserve? I think those things are oftentimes downplayed. And I think I envision the world, which is where I see US dollar heading to with the recent paper that came from MIT lab and the Federal Reserve in Boston, and including Bank of England, which happened a few months back, and SWIFT. So you have all these global agencies like BIS and World, IMF and Federal Reserve and ECBs of the world opining on where this will head. I believe that that in many cases the central bank's monetary and fiscal policy agenda, which is two things that central banks do, are meant to control inflation, which obviously the U.S. central bank has not done a fantastic job of doing that, and also helping with with unemployment ratios, are the two sort of primary function of a central bank in general. But I think in some cases we'll begin to see the stable coins be the proxy of manifesting, only because now, like for example, 300 billion, there are transaction volumes. You have talked about some of the massive sort of requirement of stable coins in the DeFi ecosystem. We have seen a massive trade in stable coins. So there's a transactional element of stable coin that's at play, whether it's used for payments or whether it's used as a step-through currency or whether it's used as a transaction medium. It's been used and it's gotten some level of success. It's a global phenomenon now that everybody can hold a US dollar in their wallets, no matter where they are in the world, as long as they're going through a regulated exchange, for instance. So I believe that with the exception of security settlement, which is a capital market agenda, I believe that the manifestation of CBDC will actually happen through different types of stablecoin. So you'll find different families of stablecoin while they're pegged to US dollar, some meant for retail sort of use, some meant for security settlement use, and some be meant for crypto settlement use. We begin to see those tiered structures come into play, as opposed to a central bank issuing its own central bank digital currencies like they have done with the fiat. That's where my head is at, because that's a faster path to market. Otherwise, I think issuing a central bank issuing digital currency can be a Herculean task, both in terms of economic policy making as well as technology agenda and who really manages that infrastructure. And the reason why I'm in India again is to figure this out. Is they had this ambitious goal that the Ministry of Finance, which did the right thing, instead of banning cryptocurrency, they want to tax it. But another ambitious goal was to issue its own central bank digital currency by next year, which is in the next 365 days is supposed to sort of create CBDC, which being close to the industry is a really, really ambitious task. It's not just about technology allowing you to issue a token. That's the easy part. It's figuring out the other facet of monitoring and ensuring you have control procedures in place to thwart bad actors and to be able to have accountability from a government and banking system perspective. And that to me is something that will ensue for at least a decade or so. And I think they'll settle in saying, look, stablecoin works. Let's just have a policy framework around it, as opposed to issuing our own central bank digital currency. I'll stop here, and Derek, to see if that made sense.
Well, it does make sense. But I wonder whether sometimes we get a little confused about the fact that a stable coin and a US dollar tether might both be in US dollars, depending whether it's a US dollar stable coin, and a US dollar central bank digital currency. And that just because they both have an outcome of what the dollar is shown as doesn't mean the underlying system is the same. They're very different, of course. And a central bank digital currency, the ramifications it might have on creating an extraordinarily more efficient economy, a more efficient way of being able to tax and get tax deductions, a more effective way of people being able to validate who they are and how they exist in the economy. None of that can be done by a stablecoin, because stablecoins are simply, they're a reflection of a value. But if we create a central bank digital currency, could you not then enable an entire new industry sector wrapped around transactions and accounting systems and tax and advice, etc., by interrogating the underlying blockchain of that central bank digital currency, with obviously an authoritarian right, and building new and efficient industry on top of it. I mean, China has done something similar to that in a controlled environment, but why can't that happen in a proactive and an entrepreneurial environment like America or Australia or India?
So I think so super interesting question. I still think going back to some of the fundamental tenets of blockchain, right? Decentralization and going after sort of, incentive economic system. CBDC, with all its merits, as you described, trying to change the financial system, trying to change the market's infrastructure that deals with payment systems, I think still centralized system, which means that while you can digitize these rails and infrastructure, you cannot fix the ill-conceived policies that may ensue in future. For example, the US pumped $6 trillion during the pandemic. What is to say that you cannot pump 6 trillion of USDC in the same mechanism, albeit at much faster pace? So right now, it took a while for the US government to distribute the $6 trillion as they doled out for some of the stimulus packages.
Yes.
Could that not have been done instantly? And could that not have instant challenges because of the fact that money is moving in real time? It's still controlled by central agencies, which means that bad policies and ill-conceived sort of distribution mechanisms can have an adverse impact, which I don't think stablecoins by themselves do, because stablecoins are still tied to supposedly scarce fiat, but the economics of stablecoins determined by the crypto economic systems too, in the sense that if stablecoins are worthless, for example, you don't see a Filipino peso stablecoin, you still see a USD euro stablecoin because they're deemed stable per se. So price stability just because we're digitizing an instrument doesn't necessarily mean that you're sort of moving away from some of the economic realities of what that asset represents, which means that in future, your USDC or USD stablecoin may also not be in demand if we are reckless with our fiscal and monetary policies. And that's why I think, again, going back to the original conversation of the three different types of stablecoins, which is collateralized backed and collateralized debt positions and algorithmic stablecoins, Algo still represents, or layer one protocol still represent the fact because they are price stable because of the underlying protocol and not some arbitrary fiscal monetary policy or bad judgment, so to speak, if that makes sense.
That does make sense. And look, this could be another beginning of a talk on futurism in this space, because just to sit here and think, what will this space look like in 10 years? So everybody who's listening, just think of what this space looked like 4 years ago. I mean, this space was kind of, it had an ICO boom dominated by Bitcoin and Ethereum, but the ICO boom was really creating things that weren't ready to a marketplace that didn't exist and to an audience that didn't understand. And so in this next 4 years, you've seen extraordinary areas getting created, such as decentralized finance, gaming, and the metaverse, of course. If you just dream forward what 10 years would look like, you're going to start probably seeing the evolving of stablecoins during that period of time, the confidence that the space might gain by aggregating its underlying distributed ledger technologies and determining a currency by that. And then, of course, this constant confluence and whether maybe it's even friction between traditional economics or TradFi and governments and the interface with this. I don't think it's a linear prediction again, because there's different countries going into this at a faster rate than other countries. I think they'll benefit from it ahead of those that are backpedaling on the way in. But this aspect of the stability of the space should be a part of a future conversation around this. Maybe at some stage in the future, Nitin, we should just get sort of 3 favorites or 4 favorites on the show and have a 1 hour session on future.
We should do that. That's a great idea. I think we should probably get diverse opinions too, and that way we can have a real debate. Absolutely. I think and also I think, as you rightly pointed out, that the future discussion is important, because anything that happens in crypto space is almost instant. The things that change, the change is really, really fast. And so predicting future becomes a lot more difficult in where this is headed. And I think that'd be super interesting, Derek. We should certainly do it.
Yeah. Okay, good. Well, we'll plan to put that together. We'll maybe make it an anniversary event. But for now, thanks for dialing in, so to speak, from India and from your interesting meetings there with the ministry. And we'll be again with a guest next week. And we look forward to discussing a new topic there. I remind everybody that we are very much approachable. And if you totally disagree with what we've just said, or you have a very different view on it, or you totally agree with us, we don't mind. By all means, send us an email along the way. I think that'll be in the outro at the end of this, and we look forward to hearing from you. But for now, look after yourselves, and we'll see you all again in a week's time. Thanks, Nitin, and look after yourself over there in India. Bye.
Thanks, Derek. Bye, guys. Take care.
We hope you enjoyed our weekly conversation. If you have any questions, comments, or suggested topics, please feel free to connect with either Nitin or myself on nitin@portal.am or derek@portal.am. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week. Bye for now.